Good morning, everyone. First of all, I would like to thank each one of you all to take time off on a Saturday morning and join the call and appreciate this enthusiasm and giving us the support required. We have organized this online event to briefly apprise you all about how the markets have moved in the past, the current scenario, and the way forward. Our speakers for today are Mr. Ajay Ladda, CEO, KSL Equity, Mr. Sameer Kulkarni, who heads our research team, Mr. Rishikesh Joshi, AVP, Product Manager and Portfolio Manager, Mr. Sonal Singhi, who is our Senior Technical Analyst. We would all jointly be giving insights about the markets today. We hope this session helps to increase the general market awareness and gives KSL a platform to build relations with you all. So without much ado, let's start the session. Over to you, Samir. Thank you.
Thank you, Pranav sir. A very warm welcome to all the participants. Thank you for joining on a Saturday morning. So, our basic agenda is all the investors are having this major question in their mind. Nifty is making new high. What should we do? And where the Indian markets outperforming all the global peers? And what is outlook going ahead? So, we will help through this presentation to give you perspective on these aspects. At the same time, we will address the equity valuations, risk and concerns, our technical view, what are the sectors on which we are positive on, and few stock ideas. So this is the calendar year till date performance of global markets. If you see here, Nifty is up by 7% versus all the global markets which have seen a massive correction, like Nasdaq, which is down by 28%. So India has outperformed by far all the global peers. So equities outperformance is mainly led by a few factors that we will discuss here. India is having one of the highest GDP growth in the world at 6.5% compared to competition, which is having a very anemic growth. That's why India is relatively more attractive to the FIIs compared to the rest of the world. We have seen a strong GST collection and direct tax collection in India over the last 12 months, and GST collections are making new high every month. We will see more in detail going ahead. In the manufacturing sector, government's thrust on production linked incentive schemes. Government's focus on sorry government's thrust on manufacturing and production linked incentive scheme is helping India to grow its market share in the export segment. India's focus to increase the export dependence from 15% to 25% in its total export is really going to help Indian manufacturing sector. At the same time, we are seeing a strong revival in credit growth, which is hovering around 15% currently. At the same time, lower provisioning is going to help banks to improve their profitability going ahead. If you see automobile sales and realty sales, they are making a new high every month. The kind of numbers Maruti, M&M are posting, they are very strong. At the same time, companies like DLF, Oberoi are making new monthly highest ever sales every month. At the same time, lower crude oil prices, which we have seen from 120, it has corrected to almost 85. That is helping Indian corporates, and that should augur well for improving margins going ahead. That's why we believe that India will have highest earning growth over the next 2 years. This has also led to strong domestic inflows from retail investors through mutual fund route. As we have seen, SIPs on a monthly basis have crossed 13,000 crore per month. At the same time, we believe that there are no signs of euphoria in the market, because if you have seen historically, the tops are made when there are large number of IPOs, when there is a sharp rally in mid and small cap companies. That is missing right now. That's why we feel that though the markets are at all-time high, they are not in euphoric zone. We believe that post recent outperformance, Indian equities are trading at around 10% premium to its last 15-year average. Investors should treat any dip towards 18,300 to 18,000 Nifty level as a buying opportunity and invest over the next 1 to 3 months in a staggered manner. We will discuss all these points in greater detail going ahead. If you see IMF global forecast, India stands out very well. India will have one of the highest GDP growth in the world. Our competition, like China, has seen a sharp slowdown post COVID, and Eurozone and US are having a low growth phase going ahead. That's why, as the competition is not doing well, India is attracting more and more FII flows. The GST collections are making a new high. Last October, we have seen 1,52,000 crore of GST collection in India. If you see most of these manufacturing themes where government is focusing on to improve the manufacturing base to grow it from 15% of total exports to 25% over next 5-year period. This is mainly led by the production link incentive scheme given by government on various sectors. Renewable energy, urban infrastructure, road, railways, real estate, defense, these are the major thrust areas of government in the manufacturing sector. If you see defense exports have gone up by 31% CAGR over the last 7-year period, which is almost 6.6 times in the same period. That have gone up to almost 350 billion in FY22. At the same time, the indigenization of defense has been going up very sharply over the last few years. Indigenization has gone up to almost 65% in FY22 now. We believe that government's focus to cut import dependence is creating a large market opportunity for quasi-monopoly defense PSUs in India. Some of the companies in this sector are Bharat Electronics, Bharat Dynamics, and Solar Industries, which are likely to have a very strong earning growth, at the same time, strong return on capital employed improvement over the next 2-year period. Even in railways, if you see, India has achieved 82% electrification in its broad gauge network. Indian Railways has drawn up a sizable procurement target for the wagons. India is targeting in next 3 years 90,000 wagons worth 350 billion rupees, and this compared to its long-term average of 10,500 wagons per year. So this is a very strong growth expected in number of wagons acquisition going ahead. At the same time, you must have seen Vande Bharat trains which are now started flying in India. In next 3 years, government is targeting 400 Vande Bharat trains with a potential to further increase in the total order size. Vande Bharat trains order book size is around 450 to 500 billion rupees. At the same time, 800 electric locomotives worth 300 billion are going to be supplied over next 10 years. This is a very humongous procurement plan in going is that is going to help most of the Indian manufacturers. Here, the finance company in the Indian railway space, Indian Railway Finance Corporation and Rail Vikas Nigam Limited are some of the companies we should look at. In the banking sector, we have seen a strong revival in credit growth post-COVID. So during COVID period, the credit growth came down from 16% to almost 5%. But in last 1 year, we have seen a very strong revival in credit growth, which is now almost at pre-COVID level, higher than pre-COVID level. This should definitely augur well for some of the banks, which we will discuss in greater detail going ahead. At the same time, we have seen a correction in commodity prices like crude and some of the industrial commodities. This should benefit India as India is a net importer of commodities. This is a very important chart, investors. You should definitely, we should definitely spend some more time in this slide. So, Sensex started in 1979. So, from 1979 till now, almost 40 years, how Indian markets have delivered the returns that we have shown here. So, if you have invested in 1979 in bank FDs, your 1 rupee would have become 36 rupees. Your 1 rupee in gold would have become 70 rupees. While in equities, if you include dividends, your money would have grown at 849 times. So that is the power of equities, investors. Equities over the last 40 years have delivered 12 times more returns than gold and 24 times more returns than bank FDs. So that shows the power of equities in the longer term. In short term, we may continue to see bumpy ride. So it is not a very linear growth in Sensex like what we have seen in bank FDs. It is a very linear, consistent growth. There is no capital erosion. But in equities, despite being a volatile asset class, over the longer period of time, it has delivered a very, very phenomenal returns and created a huge wealth for investors. So we strongly recommend that though we are at all-time high, investors should definitely add equities as asset class in their portfolio and continue to be overweight on equities going ahead. Now, if you see the valuation levels over the last 15 years, the price to earning ratio of Nifty on 1 year forward earning basis is 18.5. We are currently trading at 20.5 times 1 year forward earning. So we are almost 10% higher compared to long term average. But we feel that India should continue to command these higher valuations based on the factors which we have discussed in last few slides. Even price to book, we are trading at 3.3 times compared to 2.7 times long term average. So based on these valuation parameters, we strongly believe that investors should add equities on every dip, and 18,300 to 18,000 should be treated as a good buying opportunity. If you see how India has fared in MSCI index, so India's weightage in MSCI emerging market index has gone up in last 2 years from 7.7% to 16.2%. At the same time, China's contribution has come down from 36% to 27%. So this shows that India has been a relative outperformer in gaining market share in incremental inflows into equities. We believe that this outperformance of India will continue going ahead, and India will see a very strong growth in FI inflows in years to come. So we have to see what are the risks we are carrying at current level if we invest at all-time high. Geopolitical concerns like Russia, Ukraine, China, Taiwan are going to be there. But as we have seen in our earlier presentations, we have shown you some of the important charts. These war situations or geopolitical tensions don't have a lasting effect on equities. That's why we believe that any geopolitical concern resulting into a sharp correction in equities should be treated as a buying opportunity. There are talks about US recession. We believe that Federal Reserve is engineering a recession. It is not an actual recession. To cool off the commodity prices, to cool off the heated economy, Federal Reserve has led this aggressive rate increase plan and engineered a recession in the US. Over the last 3 to 4 months, we have seen housing prices correcting in the US. Housing sales have started slowly coming down in the US. So this should augur well, and we believe that the positive factors. So if you see, if these effects of rate increase starts to show impact on economic numbers, then Federal Reserve will start acting on the lower side. So as if you have seen in the latest commentary from Federal Reserve, they have spoken about lowering the rate of pace of increase going ahead as the inflation and some of the macro numbers are now softening. So we believe that as the macroeconomic numbers starts coming bad and bad, that will be positive for equities as that will result in a lowering of interest rates in the US. Rising yields and inflation is not necessarily a bad for equities as it gives a pricing power to most of the corporates. So what does this mean is if rate of so let's say Asian Paint, if you take an example, if the crude oil prices have gone up, Asian Paint will pass on gradually these cost increase to the end users, and that will benefit Asian Paint in terms of improving their margin profile and pricing power. We believe that inflation is likely to peak out in the next 3 to 6 months as the base effect kicks in, and in CY 23 we will see a lowering of inflation globally. Interest rates, we believe that further rate hike of 75 to 100 basis point is priced in bond yields in the US. So these are some of the concerns which we wanted to highlight. So investors should definitely keep these risks and concerns in mind at the time of investing. Now, I would like to invite my colleague Sonal to give his technical perspective. Thank you, and over to you, Sonal.
Thanks, Sandeep. Very warm morning to all investors and my colleagues. So, Nifty basically exactly last year October in 2021, it had registered a high of 18,600, and from there we have seen levels as low as closer to 15,000. So, the case is like after 1 year of efforts, we have seen Nifty finally moving about the all-time highs. And in the process, what it does, it has created an inverted head and shoulders chart formation on the charts. So, like because of that, the upside is like in an uncharted territory where Nifty hasn't moved, and also out of resistances at the same time. So, like we are of the view that while moving up also, 18,300 was respected, and when it broke past it, a swift rally of 600 points was witnessed in the last week itself. So, we are of the view that the same 18,300 should act as a support in the short term. So a range between say 18,000 and 18,300 dips should certainly be targeted to go long into buy reasonably strong stocks with good fundamentals. And what we can do is that have targets like this inverted head and shoulders pattern is projecting a target. The first target is closer to 19,200. So we were very close to it, 18,900. We reversed slightly from there. And the second target is about 20,800. So that is a long-term target. We can definitely look for the shorter-term targets and accordingly poise ourselves. Uh, the Bank Nifty too had the same thing. Uh, More or less like Bank Nifty being a heavyweight, it also guides the Nifty in the same direction. And the Bank Nifty also, when it registered 41,800 in October last year, it struggled and was trying to find a base closer to 32 and 33,000. Finally, it did, and when it did that, closer to 33,000, it relentlessly rallied, and the first halt was the last year high of 41,800. Again, we saw a sharp correction from 41,800, which came as low as 37,500 also. But then after much efforts, finally, like Bank Nifty could remove the lifetime highs, and now it is like in a very low resistance zone. And from there, it has again added up a couple of thousand points on the higher side. So Bank Nifty has done very well, and it has also led the Nifty to the levels which we are seeing as of now. So we expect the same performance going ahead, and dips close to 41,000, 41,800, 40,800. There are few supports. The range should be between say 40,800 and 41,800. This range should be bought into, and we should be certainly looking at targets very close to the first target is 44,900, and the next target is about 50,000. So that is a long-term target, but then the probability is, as of now, it seems pretty high. So as Nifty broke out of a inverted head and shoulders pattern, Bank Nifty also has broken out of a cup and handle formation, and we can certainly be very the probability is pretty high that we could see the targets achieving shortly. That's it, mine. Thanks. Sorry. Nasdaq. Also, we wanted to highlight this particular index in the sense that Nasdaq also had been struggling close to 11,000. Not long back. It's like a month or a couple of months back also. So 11,000, it formed a very good base, and twice it made an attempt. The first attempt was restricted again close to 13,500, and the second attempt again we saw it again creating a base. So what we are seeing is that if you look at the screens, there is a falling trend line which is very close to the current levels. It is now at 12,000. So if you see a breach about 12,000, nothing like it, we'll definitely have a very strong and good leg of the rally on the higher side. The first halt will obviously be the 13,500 races levels, which it witnessed a couple of months back. And the next will be above 15,000 in all. So we are definitely looking at Nasdaq as, and we'll be adding more when it breaks up. And one more case that it has underperformed and created a good base. So we'll be looking at the set targets 13,500 and 15,000 in the short to medium term. That's it, Mike. Thanks a lot. Thank you. I'll hand over to Rishikesh, my colleague. Thank you.
Thanks, Sonal. After these, we would be, having this idea about investment, themes, key investment themes that we would like to share with you. So we have been strongly advocating growth stocks over all these years, and we continue to like them. But what has happened is the value stocks is something which have developed over last 1 year or so, and that is because of the fact that this value stocks are something which are having good earnings growth to some extent, and of course the valuations are extremely attractive. So all these things are a part of it, and that's the reason why we are kind of suggesting them. We would like to take you through it in detail in further slides. So cyclical stocks or the value stocks will be, having the PSU banks, some utility companies, commodities, industrials as a part of it, and which are something that we really like now and will continue to like at least next couple of years. These things look really, really attractive. So on the next one is the banking and the finance. This is one sector that we again like a lot. So there are a couple of reasons why we like this, and that is one is the asset quality has improved drastically for all these banks after a lot of cleanup which has happened in last 2 to 3 years. Post COVID, especially, things have really, really better, and that's the reason, one of the top reasons. Another reason is on the credit growth. So credit growth, which was very anemic earlier, less than 5%, 7% or so, has kind of improved and is in a range of 15 to 20% depending upon which bank we are looking at. So which is something really, really good in a way, because credit growth will hints us at the strong economy, as well as the promoters want to take more and more loan, more and more credit, and the banks are also willing to give it because they have a clean balance sheet now, and the asset quality is much better what it used to be some time back. So to have this strong credit growth, we have good CASA as well now with the bank, the current account savings account ratio, which funds in a way these strong credit cycles. So we like these banks. So like we have top banks like ICICI Bank, State Bank, PNB, Bank of not PNB, sorry, Bank of Baroda is something that we really like a lot. Axis Bank, we have started liking that as well. Mm. So here in this chart, especially what has happened is the asset quality is a long-term chart. So asset quality has gone through a lot of ups and downs. So in 2018-19, the GNPA was as 10%. So now it has reduced down to 4%. The net NPA has gone around 1%. So that is really an encouraging sign for the banks to willing to lend and really willing to do the business, which is something we are looking forward to. So after the banking, we like the manufacturing sector a lot. So the manufacturing is a clear focus by government of India, and they say that 15 currently the 15% of GDP is the manufacturing sector, and now they want to take it up from 15% to 25%. So that's a big jump, and there are a lot of companies which will be beneficiary of these, the increase in terms of the manufacturing in the GDP, so to say. So, what are the key drivers? The government is of course pushing from their side. China plus one is another major thing which is really inching up and making sure that things are moving up to India. We have seen a lot of big companies who have, let's say, based out of let's say Europe, are shifting their plans or shifting their manufacturing units to India. So that is something, a structural story which is happening. The government's initiative, of course, with the PLI scheme that we know is something which has having a lot of thrust on manufacturing. So all these things put together is something which will kind of ensure that manufacturing as a sector will be in a boom for next at least 4 to 5 years, and we would really urge investors to really participate in these sector. So here is nothing but the capacity utilization chart, which we have seen the 17, for last from 2009 onwards to 21 now, 21, 22. So we've seen that, the capacity utilization in 2011-12 was peak in a range of around 80 odd percent. So it had dropped down to as low as, 50%, 55% recently in 2020-21. And now it has steadily, kind of gone up. Now it is around that 75-80% mark. So which means that when the capacity utilization is at that level, promoters and the business people would try and make sure that the new manufacturing capacities come up, which will ensure the capex goes up, and of course, which will make sure that credit growth also picks up in the corporate lending sector. So banks benefit, the manufacturing sector benefits, and overall the economy benefits. That's the something that we would like to highlight here. Now the top picks that we have here is ABB, Siemens, and Thermax are the stocks that we like here a lot. So another sector that we are really gung-ho about is housing and allied sector. Here we see that the realty prices have been quite stagnant for last like 7-8 odd years, and they've just started inching up last 1 year or so. And the EMI also as a percentage was housing EMI as a percentage of salary also was lower, so that make sure that people have more and more money to kind of buy new house and so on and so forth. So what we feel is post RERA and the GST, organized sector market share will gain, and the realty companies will do really good in a way. So the key stock that we have a recommendation on is Oberoi Real Estate. Apart from that, there are some allied sectors like Asian Paints, Polycab, Astral, Pidilite is something that we like a lot, and we'll continue to like them ahead as well. So that is something in the housing and allied sector that we'd like to recommend. Yeah, again, the opening up trade. So that again, so we know that after post-COVID, things have been under a lockdown, and that's where we've seen a lot of problem around these areas. So now with the things picking up in the economy, so we feel that these opening up trade is will do wonders, and we would like to suggest like Indian hotels trend as one of the top picks here. So coming on to the stocks, as I was mentioning about the PSU segment, so I'd like to suggest this PSU Bank, Bank of Baroda. So we all know about Bank of Baroda. Has is one of the really good banks in terms of so just after SBI. So Bank of Baroda has this strong pan India network. Post COVID, it's very heartening to really understand that the credit growth, of course, has picked up, but there are different ratios that we analyze, like the net non-performing asset or the margins of the bank, the return on assets, all of them have improved. So non-performing asset, which was as high as like 4% during the COVID times, is now less than 2%. Similarly, the margins, which were like 2.5%, 2.7% earlier, has gone up to 3.5%. Similarly, the return on assets has also improved, which in a way indicates that bank is really doing the right things in the right way, and that is the reason why we like this Bank of Baroda. Also, the valuations are really attractive. So, if you really look at the book value for the Bank of Baroda, it is around 205 rupees. So, we have a target based on the book value, which is into 1.3 times. So, which we arrive at 270 rupees odd as a price target, which will be for next 12 to 18 months. So, we really recommend the investors to invest in Bank of Baroda. And now, even now, and let's say if there are any dips, we should still buy. So that's the view. Here are some numbers for Bank of Baroda. Now, the second bank that we like is Axis Bank. So Axis Bank again has, if we really see in terms of chart, hasn't done anything great for last 5 odd years, but the bank had gone through its own challenges over last 4 5 years, and hence that was the reaction in the stock price for last 4 5 years. But things have improved, and looks like they'll improve further. And that is because of a lot of efforts that bank has put into making sure that again the asset quality has improved, the margins have improved, and also the credit growth has improved over all these years as well. So banks has been focusing on the digital aspect. So that's the reason why even there also bank scores a lot. The valuations are attractive. So if we see around the book value is around like 500 rupees, and the bank price is around 900. So we feel that over the next 12 to 18 months, from 900 to 1200 is easily possible for bank for Axis Bank, and hence we recommend this strongly. So apart from these two banks, we would like to recommend the Motilal Oswal Nasdaq 100 ETF fund, and that is because of the fact that the Nasdaq has gone through its own challenges over last 1 year or so, from correcting from 15,500 to around 11,000, 10,000, in fact, and now it is little up around 11,000. So why Nasdaq is because it includes the companies like Apple, Microsoft, Alphabet, Intel, which is something which is really good in a way, because these companies have shown a lot of growth in the past. The valuations are attractive now, and there has been a lot of correction in these stocks as well as in a Nasdaq. So we feel that this is a good opportunity to diversify the portfolio and to invest in these in these companies via ETF, and that's the reason why we suggest this very strongly. So this is nothing but what all components are there in Nasdaq. So 13% is like Apple, 10% Microsoft, Google, Alphabet put together 7-8%, Amazon another 7%, Tesla is 5%. So all these companies are really worthwhile to invest, and we would suggest that ETF is one of the best efficient way to kind of invest in these kind of companies. So this is our indicative portfolio. So we have like we would recommend around 85% in large cap and around 15% in mid cap. So around 35% plus is in the banking sector, then in auto, telecom, consumption, so and so forth. So Nasdaq around 7-8% is what we recommend. So here we'd like to mention that we can although the market is at all-time high, we should There could be certain small corrections in the market, so we're not expecting anything big out of it. But we should keep some cash handy, and that's the reason why I would suggest that you can sell few of these stocks, maintain some cash, and that's the reason. And if there are certain dips, let's say like around 18,300, you should look to buy the stocks at those levels. This is our indicative portfolio. The name of the stock, sector, recommended buy level that we had, the targets, allocation, and the returns. Thanks everyone, and would suggest if all of you can share your portfolios, we would like to kind of get back to you on our analysis after analysis on your portfolios. So request you to share your portfolios. Thanks a lot. So now if there are any questions, please feel free to kind of ask them. We can unmute you. Alternatively, you can put it in the chat box and we'll be able to take this up. And let's make it more interactive. Thanks a lot.
Thank you, Rishikesh. We have already have few questions in the chat box. So I would like to invite Ajay Redda sir to give his perspective on why he believes that India is getting this high PE, why the PE is upgraded over the last few years, and is it sustainable?
So I think one of the main reasons we have a high P is right now that our competition is not doing well. So globally, we have three very large blocks which contribute to the global economy. That is China, US, and Europe. And each of these blocks have their own problems right now. Uh, China, their zero COVID policy doesn't seem to be working, and they have not been able to get the COVID under control. Their vaccines have not been very effective, and you see that every time there's a COVID in some place, they lock down whole cities. Apple will lose huge sales this time during the Christmas season. Europe also, it looks like the Ukraine Russia war is not going to get over in a hurry, and gas prices there are almost 5 to 7 times higher than earlier, and this is going to have a huge impact on them over the next 2 to 3 years. US, the economy was doing well, but because inflation was very high, the Fed has tried to engineer a recession. So it will take, I think, at least 12 to 18 months for the economy to come back to normal. So, because of various structural reforms that we have had in the last 3 4 years under this government, a lot of FIs believe that relatively higher growth in India is sustainable over the next 3 to 5 years. One more reason is that India has been talking the language of capitalism. So we have reduced taxes, we are talking of PRI scheme, whereas China is now talking the language of socialism, and FIs don't like the language of socialism. In China, he is talking about redistribution of wealth from the rich to the poor, and markets don't like. You see, there have been a lot of restrictions also on private sector companies, on Alibaba, Tencent, whereas India has been liberalizing. So the language that we are talking of welcoming flows, this language of capitalism. So Modi knows what to talk FIs, what they like to hear. So though our valuations are slightly up above long-term average, we believe that they could sustain over the next 3 4 years. The risk here is that if the others get their act together, so if China gets back to, if they're able to control their COVID policy, if they're able to control COVID and get back to growth, or if Europe and US come back faster than expected, then our valuations could again come back to the longer term average. But next to 3 years, it looks like we might have slightly higher valuations than long term average. And because of these structural reforms, maybe our valuations will settle at a slightly higher level than the historical level. Thank you.
Thank you, Ajay sir. There is a follow-up question to Ajay sir only. How KSL select stocks and recommends these fundamentally and technically very strong companies?
So historically, we have had a rule of looking at 5, 10, 15-year numbers, and we try to identify companies which grow in the range of 15 to 20% consistently over this 5, 10, and 15-year period. And second parameter is that they should have a very high return on the capital they employ in their business. So if Asian Paints has employed 100 rupees in its business, which includes its plant, machinery, working capital, we expect it to generate a return of 15 to 20 rupees on this capital that they've employed in their business. So a growth of 15 to 20% and a return on the capital that they've employed in their business of 15 to 20% over 5, 10, and 15-year period. This has been the way that we select stocks predominantly. But sometimes, especially in the last 18 months, we have also tried to look at sectors which are having a turnaround and which might do well over the next 18 to 24 months. So PSU banks is a sector which we have historically avoided because PSU banks do well in spurts. So for example, the banks did very well in the period between 2003 to 2004 to 2007, 8, and they didn't go anywhere then between 2008 to 2000, almost 2021. They had a small this thing in between for 2, 3 years uh, because their NPAs they lend very aggressively during this period of 2003 to 2008, to especially towards 2007, 8, and some sectors that they lend to like power and metals, they went through a bad turn over the last 10 years. But now this sector has turned around, and so we see a 18-month to 24-month trading opportunity here. So these stocks would historically not have come into a parameter of 5, 10, 15-year consistent growth. But sometimes you see a turnaround in a sector and you buy that sector. Similarly, sectors like hotels would not have come into our scanner, or defense companies would not have come into our scanner because they haven't grown consistently over 5, 10, 15-year periods. But now with the reforms, it looks like they will grow in the future. Hotels also, because people didn't travel during COVID, and these sectors also reduced cost structurally significantly, and they were much lower cost base. So we believe that some of these sectors would do well over the next 2 to 3 years. But otherwise, defense and railways have not created much value over a 10, 20-year time frame. But because of the very strong focus of the government on these sectors, we believe that they could create value over the next 2 to 3 years. And also their valuations have become very reasonable. So I would say that 80% of our portfolio would be in stocks which have grown consistently over a long period, and 15 to 20% of our portfolio might be in stocks which could do well over the next 18 to 24 months, which are trading opportunities, not long-term plays. Thank you.
Thank you, Ajay sir. Next question is for Sonal. On technical parameters, which are the sectors you like the most?
Yeah. So we were bullish for Bank Nifty for quite some time, and we would still be quite hopeful that despite such high levels, the bank index will outperform, and certainly it is taking a bit of rest as of now. But then we don't think it is anywhere near to its highs. We still think that the steam is still left, and we could see and scale much higher levels going forward. So apart from the banking index, we are looking at the IT index, which has lately broken out. Just last week itself, it has broken out of a very good range. That range it had maintained for quite some time, and after much efforts, it is finally able to surpass the resistance level. So IT index lately has done pretty well. Metals, you can forget metals, JSW Steel, metals and all are doing, but the sector as a whole is doing good. So within that, JSW Steel and Cement Power also can be looked at. To some extent, capital goods, real estate sector, selectively into real estate sector, the infra sector has broken out. And for quite some time, the FMCG index and the MNC index have been doing well. So roughly like this 6-7 sectors should be targeted. Thank you.
I would
Thank
also
you,
like to
Sundar.
add auto here. I would also like to add the auto sector here. That also looks good over a slightly 3 to 6 month period.
Just to add a few pointers on auto, we have seen a very strong revival in auto sales. And at the same time, if you see Maruti's contribution from SUV segment has started going up after a long period of time. So Grand Vitara has seen a very stellar number of booking, 1 lakh plus vehicles were booked for Grand Vitara. They have a very strong lineup in some of the SUV segments they're going to launch over the next 2 year period. So India, as the consumption improves, as the per capita GDP improves in India from $2,000 per person to almost 4 to 5,000 over next 5 to 7 years, we will see a strong revival in consumption. The car per sales in India is very low. Car number of passenger vehicles per thousand people is hardly 10 or 12 in India compared to very high number globally. So we believe that as the aspirations go up, as the consumption and income levels go up, we definitely will see a strong revival in auto sales. The next question is on mid and small cap. Is it a good time to have small and mid cap more in comparison to large caps over next 2 to 3 year with a 2 to 3 year view? So I would like to take this question. So mid and small cap, as we have seen in last 1 year rally, mid and small cap companies have underperformed. But historically, we have seen the first rally is always led by large cap companies, and then we see a follow through by mid and small cap companies. So that's why in our portfolio, we are recommending 85% allocation to large caps and 15% to mid cap companies. There was a question about PSU companies. So we have discussed, Ajay sir has given a few pointers on the PSU companies earlier. Ajay sir, we have a next question on whether investors should create liquidity in the portfolios in such high market situations.
Oh, I don't have a very good answer to this, but my belief is that the index could give you returns of around 12 to 14% over the next 1 year. There could be rallies, there could be corrections of around 5 to 10% in between. But I don't have a very good answer to whether there should be some cash in the portfolio right now, because we are not seeing very large corrections right now.
And as we have seen, as we have shown in the earlier slide, we are not in the euphoric zone like we have seen in last peaks. The peak was made with a large number of large IPOs. Then the small cap and mid cap were rallying very sharply, 20% upside in 1 day. So that kind of upside or that kind of euphoria is not there currently. So that's why we feel that creating a huge cash in the portfolio will be risky. So investors should take a calculated view before creating this cash.
Also, the market has consolidated for almost 1 year now. For the last 1 year, the Nifty returns have been close to zero. So after a huge rise in the earlier year, we have had a good 1 year of consolidation.
Thank you. Next question is on pharma sector. So Rishesh, your view on IT and pharma sector, please. Thank you.
Yeah, thanks. So IT, yes, I think in past also I've been saying about IT sector, because IT has gone through a rough time, and as of now the valuations are still reasonable. So Infosys is trading at around 24 times on next year, so which is still reasonable in comparison to the growth. So we don't expect something great in share price appreciation, but yes, they would be little better than the market performance. So that's what the expectation is. post whatever correction that the stocks and the entire sector has gone through. So yes, there could be some dips, but I think we should use this as buying opportunities rather than kind of, and should consolidate and increase the position in IT for sure. Pharma has gone through a lot of challenges in recent past, and looks like it will continue to do so. But pharma could be some kind of a contra bet, because the valuations are now getting attractive post the correction that we have seen in the markets for pharma segment. There have been a lot of pricing pressure, especially in the US based companies, and that's where the earnings are not there, and hence there is so much of correction which has happened in the stocks. But this could be kind of a temporary thing post the correction that we have seen. I think pricing will stabilize over next 6 to 9 months, and things should look up after that. So don't expect great appreciation in pharma stocks, but there could be little more pain. We should be choosy, and we should look into the stocks which are really good, which would be good in terms of earnings over next 1 to 2 years, and that's where I think we should commit money, and that too in stages. So that's certain. That's the thing about pharma that we'd like to suggest.
Thank you, Rishesh. This is the next question is for Ajay sir. Uh, Kindly share your views on PSU stocks like NTPC, REC, and Coal India. So, some of the PSU companies, what is your view, sir?
Uh, so one view of looking at these PSU companies is that they could be options to bank FDs. Like a company like Coal India gives a dividend yield of almost 9 to 10%. NTPC gives almost 4 to 5%. REC, the dividend yield is almost 10%. So even if the price didn't go up for some period, you can keep getting a dividend yield of around 8 to 10%. But our belief is that these stocks are undervalued and have upside potential, because the government has been also making changes in the PSU sector. For example, earlier CEOs in banks had very often tenures only of 18 to 24 months. Now the idea is to give them tenures of at least 5 years. Uh, so there have been reforms in the PSU sector, and the government wants to come out, uh, has a divestment calendar for PSUs, and I think these reforms in the PSU sector will continue. So valuations in the PSU sectors are quite attractive, and uh, there has been an improvement in both growth in the sector and in the return on capital employed of various companies. So I would say that they could outperform the market over the next 24 months, the PSUs. And this dividend yield gives us a good comfort. Ki agar the price didn't go up, at least I get a yield of 10% on my capital employed in terms of dividends.
Thank you, Ajay sir. The follow-up is on your views on equity markets before budget and post-budget, how they will move.
So my belief is that this rally could continue a little bit before the budget, and maybe we'll have a correction post-budget. But I don't have very strong views either way. Only my belief is that broadly corrections will be shallow, and we should use dips to keep buying the corrections. But there's a chance that we could have a small pre-budget rally. That possibility remains.
Thank you. So, the last question is on some of the investors are asking, Ajay sir, who are the major investors you follow while investing in equity markets?
So we follow some leading fund managers in India like Prashant Jain and Naren. Prashant Jain from HDFC, Naren from ICICI, for their growth style philosophy, for their value style philosophy, and There are also some people who have good style, like Mr. Gopani from Axis. But globally, our style is more like Peter Lynch, where we are buying companies which have grown consistently at 15-20% over the last 10 15 years, and where we believe that the growth could continue. And we also like Warren Buffett's or Charlie Munger style of buying very high quality companies which have very strong competitive advantages, which could be in terms of a very strong brand, a very strong distribution network, uh, and very large dominant market share in their respective sectors. So let's say in paints, Asian Paints has close to 60% market share, or in banking, banks like HDFC Bank, ICICI Bank have very large market share. So these are some factors that we look at, but we have been very focused on quality historically. That has been our style.
Thank you, Ajay sir and KSL team for an insightful presentation. Now, I would like to invite Rino sir for giving the closing remarks. Over to you, sir.
Thank you, Samir. We at Khandwala Securities Limited take this opportunity to thank one and all for attending this our monthly dialogue on market and where we see the markets going from here. As key takeaways from inputs given by my colleagues, I think so there are multiple internal and external factors which impact the capital market movement. And capital market is always considered as a barometer for future economic growth. Say from the PM's vision of 5 trillion economy or 100 years of independence, wherever we see, there might be intermediate corrections, but markets will always move up. One has to take dips as an opportunity. Periodic review, rebalancing of portfolio is always the mantra which can help consistent growth. Whether I heard a question on sitting on cash, I think so. Sitting on cash should be replaced with rebalancing your portfolio from time to time, depending upon your risk profile as well as your the market positions. Finally, we can conclude saying that we have to ride India's growth and India's position in the global economy as compared to other peers which are there. Stay invested, stay growing. Thank you very much.